In this video, we're going to go over important updates, and more specifically, we're going to focus on the earnings report. So in this quick video, we're going to cover what are important updates, how you can actually receive one on your Simply Wall Street account, why they're so important, and how you can actually use them, like what insights or takeaways you can infer from when you receive one. And then we're going to cover some examples of different outcomes of this particular earnings report. And finally, I'll touch on where you can go to do some more due diligence. So for starters, what are important updates? Well, just to give you a quick summary, they're basically quick and brief updates that displays important information relating to any stocks that you're watching or following. So that could be stuff like earnings reports or insider transactions or executives leaving a company or upcoming dividends. Any sort of information like that that is considered very important, you'll receive an update on it if it's a stock that's relevant to you. So speaking of stocks that are relevant to you, how do you actually receive an update? Well, on your Simply Wall Street account, if you simply add a stock to your watch list or to your portfolio, it's straight away eligible to start receiving these important updates. So if you've added a stock to your watch list or portfolio, you've told us that that company is important to you, and so that now will be eligible to receive these important updates. So why are important updates so important? They help you monitor stocks that you're following, right? So it basically gives you a quick and brief update on the important information without you having to go and do all the reading and research yourself. So it helps you to remain informed on the fundamentals at like a high level. So it gives you a quick summary of everything that is relevant to that particular update, and it allows you to then know if you want to go and do more digging. And lastly, it basically saves time during your monitoring and research phase, because without the important update, you would have to go and manually read through the earnings releases or read through the annual reports or read through the company's SEC filings or something like that to try and find this information that otherwise wouldn't have been accessible. So these important updates are really useful just basically to be notified of when these developments occur. And one thing to note is that they come, for this particular earnings report, they come out quarterly, half yearly, or annually, depending on when the company has released its latest financial results. So other important updates that aren't related to financial releases of like quarterly or half yearly or annual information, they can be released whenever the update is occurring, like if an insider decides to sell shares or an executive leaves. But these earnings reports are based around when the company posts its financial results. So how can you actually use the earnings update? Well, this update is a very useful summary of how to stay up to date with the company's revenue, its net income, its profit margins, and also how its earnings per share has compared to its share price growth. And I'll go into that in more detail in just a moment. And lastly, if the company is is part of any particular industry that we deem within a certain criteria, we'll also provide details on any sort of particular metrics that are very relevant to that industry. And I'll also cover that in more detail just a bit later on. So I want to go through some examples and share with you some different outcomes of the earnings reports and show you not only the updates, but how that actually has occurred in the underlying business, right? So let's look at this first example. We've got revenue increases and net income increases. So in this particular example, you can see that the company has posted a very good report, right? Its first quarter results did well with improved earnings, revenue, and profit margins. And you can see here that the revenue and net income, all the figures here are compared to the prior corresponding period. Now, if it's annual, that figure will be compared with the previous year. If it's a quarter, that quarter will be compared with the previous quarter for the previous year, right? So in this case, it's the first quarter results and they're being compared with the first quarter for the year prior. And so we can see here that everything has gone up and pretty much everything's going up and to the right. And we can see here that the revenue was driven, or the increase in margin, was driven by higher revenue. And so this data here may be like it's great on the surface, but it's very useful to know how it actually occurred. So if we were to actually look at the income statement, which is this right here, what we can actually see is we can see how that developed. So we can see here that the total revenue actually increased, right? And so the revenue increased, and while these operating expenses increased as well, they actually didn't increase as much as the revenue. Therefore, the net income increased, right? And so that's also what drove the increased profit margins, because the top line being sales grew so quickly, and while these operating expenses grew as well, it wasn't the same trajectory as what the revenue grew at. Therefore, profit margins increased, which we saw was driven by the higher revenue, and the net income increased, which was what we saw in that dot point as well. And so this is back to that same earnings update. And the last bit we can see here is that it compares the earnings per share growth to the share price growth. And so we can see here that over the last 3 years, on average, the earnings per share has increased 28% per year, but the company's actual share price has increased 45% per year, which means that the share price is growing significantly ahead of earnings per share. And that might be a bit confusing, right? Like you would think, oh, if the earnings are going up 28%, then surely the share price would go up the same amount. Not necessarily, it doesn't have to be the case. What this means and what we can infer from this update is basically that investors are very optimistic on the stock, right? Because although the company's performing well, investors are willing to pay a higher price for it because they have higher expectations of the company's future performance. So that's one situation where you may look at this and go, oh wow, like that's interesting. Investors are really optimistic about the stock because they're paying even more for it. Like the share price has increased higher than the actual underlying earnings of the business. Where can I go to find out more information about this? And so where you can go is at the company's future growth section on the Simply Wall Street Company Report, right? Because that future growth section will show you what the expectations are for future earnings, future revenue, and basically any sort of prospects or expectations of the future will be displayed in that section. You can get some more context on it there. So for this second example, we want to show a similar sort of thing, but actually a different outcome, right? So this is a situation where revenue has decreased, but net income has increased. And now this is sometimes confusing for investors because it might be like, oh, how can net income increase when revenue being sales decreased? And I'll explain how that can be the case. So we've got the similar sort of format where it's like improved earnings and profit margins, although revenues are weaker. And to get more context on these numbers here, it's important to understand where they came from, right? And how it can actually come about. And so if we were to look at so as we can see, revenue dropped, net income up, and profit margins up. If we want to get more context on it and actually understand how it happened, you'd have to look at the income statement, right? And so to understand how that occurred, this is pretty much how it happened. So total revenue, being sales, decreased. However, the operating expenses, which is this like research and development, sales, general and admin, like marketing, these kind of expenses, decreased more, right? So they actually reduced it at a greater scale. And so because those expenses reduced more than the revenue actually dropped, the company's net income actually increased, right? So it cut costs much more than it actually lost in terms of its reduced sales. And so the company's bottom line, being its profit, increased. And so for this same company we're looking at, if you wanted to get more details on how that actually occurred, you can go to the past performance section of the company's report on Simply Wall Street, and that can show you how the operating expenses have been trending and how the revenue's been trending over time over the past couple of years, and that will give you more context to understand how it's actually happened. And now in this same example, we have a look at the bottom section as well, which is the EPS versus share price growth. And so we can see over the past 3 years, the company's share price growth has exceeded its earnings growth by a rate of 50 percentage points per year, which is a significant difference, right? So similar to the situation prior, where the share price has outpaced the earnings significantly, you've got a situation where investors are very optimistic and they have high expectations of the company's future earnings growth. And so if you want to get more context on that, again, you can go to the company's company report on Simply Wall Street and have a look at the future growth section and see how the expectations are trending for like analyst forecasts of the future. And that'll give you some more context on how that's been trending. And you can also check out the EPS section within the future growth part and just see how it's been trending previously and how it's expected to trend in the future based on future expectations. And lastly, I just want to give one more example, and this is a situation where revenue has increased, but net income has decreased. So you might think, oh, the company's making more sales, therefore it should generate more profit. That's not necessarily the case. And so I want to explain how it got there, right? So revenue here has increased by 16%, right, to 89.2 million, and the net loss, because the company in this case isn't profitable, has actually increased or widened by 37% from the same quarter last year or the year prior to $22.9 million in terms of losses. And so to get more context on that, it's important to understand what actually happened in the underlying business. And we can see here that obviously total revenue has increased, as we saw, by 16%. However, the company's operating expenses have actually increased like quite a lot. And in this case, it seems that the operating expenses have actually increased at a higher rate than revenue has. And therefore, because of that, the company's net income has decreased, right? So it's making more money in terms of sales, but it's also spending a whole lot more money. And that might be a case where the company's heavily reinvesting in itself, like in its research and development or its sales and marketing, that kind of thing, to grow its business. And this is a case where it's like, okay, it's generating more sales, but the losses have increased because it's reinvesting in itself so much. And so the final part of this chart this update, is actually interesting because it's slightly different from prior to. So we can see that over the last 3 years, on average, the earnings per share has actually increased by 10% per year, but the company's share price has actually only increased by 1% per year. So it's actually significantly lagging earnings growth. And the takeaway from that might be, oh, okay, well, it's the opposite of what we saw before, right? Where not expectations from investors aren't actually exceeding the company's performance, they're actually lower than the company's performance. So the earnings per share have been increasing by 10% per year, but the share price has only increased by 1%, meaning that investors don't have the highest expectations of like future growth, right? Like they're not expecting that much earnings growth in the future. And so to get more context on that, it's very useful to, again, go to the company's report on Simply Wall Street and check out the future growth section just to see how those lines are trending in terms of analyst forecasts of the future, to see if they are actually expecting any growth at all, or if it's actually expecting like a decline in the future, because that'll give more context to that comparison. And so, as I mentioned, there's some industry-specific metrics that we check in particular industries. And here's a whole list of them here. I won't go through it now, but basically, if the company is reporting its annual figures, we will check these particular metrics and see how they've been performing. And they're very useful to look at for these particular industries, because these are very critical metrics for these particular areas and spaces. So you can pause the video and have a look at those if you like, but just know that annual figures will also display these figures here as well. And lastly, where can you go to do more due diligence? So I've mentioned a couple of times in the video already, but this is obviously the earnings update that you'll receive. And if you want to go and do more research and actually dig a bit deeper on the metrics that we've looked into and the data that we're providing, you can go and check out the company overview, which is basically the top of the company report. And then also you can obviously check out the future growth section and the past performance section in the company's report on Simply Wall Street, because that will provide you with a whole bunch of metrics as well and the latest figures that have just been reported. So I hope that's all been helpful. Thank you so much for watching.